Spring may be just about in the air, and as we say goodbye to February and hello to March, we've got a good dozen FTSE 100 firms primed and ready to report numbers or provide a trading update in the week ahead. They include Primark owner Associated British Foods on the 27th, silver miner Fresnillo, support services stock Babcock and insurer Direct Line on the 28th, as well as media giant WPP and FTSE 100 healthcare newbie Convatec on the 3rd of March. But for me, the one name really capable of causing a fuss is house builder Persimmon, which is due to release its fourth quarter and full year results on Monday the 27th of February. By the way, Pia Telly-Wimpey reports on the 28th. Now, so far as York headquartered Persimmon's concerned, last year's EU referendum vote and the worries about the housing market that it sparked must seem like a long time ago, at least judging by the share price, which has nearly recaptured all of the ground that it lost, as we can see here. Now that recovery has been driven by the government's launch of the Lifetime ISA from April 2017 and the Help to Buy ISA, which runs until November 2019, not to mention record low interest rates from the Bank of England. All three seem to be helping to stoke housing demand when supply is still struggling to keep up. Commentary from Persimmon itself has reflected this tight nature of the market and has therefore had a soothing effect on the stock. January's trading statement flagged an 8% increase in revenues as completions and prices both rose 4% for the whole of 2016. The FTSE 100 firm also flagged a 12% jump in forward sales and a £900 million plus cash pile. That means the key number to watch in the full year 2016 number is pre-tax profit. Analysts are looking for £750 million against £638 a year ago. The really important stuff will therefore come in the form of the outlook statement and any guidance that we get on completions, where we can see the trend over the last 10 years here, and we're still below 2006-07 levels. Prices, where we can also look back 10 years here. Persimmon's average of £206,000 is the lowest of all of the big quoted builders as a result of its geographic mix. It just sells more in the north than it does in the south. And of course, look at pre-tax income. Here, analysts are looking for just a 4% increase to £777 million for 2017 as rising cost pressures play a role, something already flagged by Bovis. That leaves one final big number, the dividend. Remember that Persimmon's deep into a huge cash return programme where it intends to return £1.10 a share for this year just ended and each of the next 4, or £5.50 a share on the 20 quid share price. That 110p a share annual payout equates to a dividend yield of around 5.6%, one of the highest dozen or so in the FTSE 100, with earnings cover of 1.8 times compared to the index average of 1.7. That's why some analysts are now homing in on the builders as yield plays. This next graphic shows all the leading quoted house builders looking at their dividend yield, the bar, and the forward price earnings ratio, the line. If you agree with this income thesis, and I say if, you need to ask, what would happen if there's a housing downturn? Unlikely as it seems at the moment, in terms of profits and therefore dividend cover. In the event of a deep downturn, Persimmon probably could hold us 110p dividends by using up its cash pile rather than buying land. But buying land cheaply is what makes the builders tick in the long run, so that would be a big strategic call if push comes to shove, dividend versus land buying, but I do stress if. And thirdly, in the end, what chance is there of a housing downturn at the moment? A PE of barely 10 on Persimmon suggests the market is still frightened of one post-Brexit, so let's see what Persimmon has to say when it reports next week. Thank you for watching, and I look forward to seeing you next time.